As of 10:13 a.m. Eastern Time on November 3, 2025, Plug Power, ticker PLUG, is trading at $2.77.5, which is up about $0.085 on the day, or 3.16%. It's a green day, a slight bounce, and if you're new to this name, you might see that as a sign of stabilization. But the immediate, pressing insight you need to have is that this 3% move is noise, a distraction from the fundamental tension that defines this company right now. The market is currently, and perhaps dangerously, confused about what is happening in Washington. The expectation is that the $1.66 billion loan guarantee from the Department of Energy, which the company secured back in January, is the ultimate safety net. The reality is that the entire federal framework for hydrogen, specifically the $7 billion allocated for the regional clean hydrogen hubs, was just terminated by the new administration. Investors are clinging to the belief that Plug's loan, which is from the Loan Programs Office, or LPO, is separate and secure. But they are completely ignoring the fact that the other major government support mechanism for the entire industry just vanished. And this company's survival is now balanced on a knife edge ahead of its earnings report just 8 days from now. Let's establish the common ground, the story everyone believes about Plug Power. For years, this has been the poster child for the hydrogen economy. It was a story stock, a retail favorite that you'd see discussed constantly by people engaging in online investing for the first time. It became a darling on the Robinhood app, a place where Robinhood fractional shares allowed a new generation to buy into a narrative. The expectation was that PLUG was on a path to be the Tesla stock of hydrogen, a vertically integrated giant. People saw the stock collapse from its highs, and now, looking at a $277 share price, they see a bargain. They see the $1.66 billion DOE loan as a government stamp of approval, a sign that the company is too big to fail in the green transition. They look at their individual brokerage account, maybe on the Fidelity mobile app or through SoFi Invest, and they see a high-risk, high-reward bet that feels like it's finally found a bottom. This is the expectation. The worst is over, and the government loan has de-risked the investment. Now, let's challenge that with the cold, hard reality. The $1.66 billion loan is not a briefcase of cash for operations. It is a loan guarantee tied to financing the construction of up to 6 specific hydrogen production facilities. It does not, and never intended to, fund the company's staggering operational cash burn. And this is where we find the elephant in the room, the company's own balance sheet. When Plug Power reported its second quarter earnings, it finished Q2 with only $140 million in unrestricted cash. This is a company that, even with its Project Quantum Leap cost-cutting, still burned through $152 million in just the first quarter. While the Q2 cash burn rate improved, the math is unavoidable. $140 million in the bank does not last long for a company that has historically burned hundreds of millions of dollars per year. The reality is that Plug Power is in a desperate race against time. The DOE loan is for building the future, but the $140 million is what's paying the bills today. And as we speak, the macro-political environment has turned completely hostile. The new administration's termination of the OSED hydrogen hubs sends a clear signal: the government is not a buyer of last resort for this industry. The $1.66 billion LPO loan, while technically closed in January, now faces immense political scrutiny. Will the funds be delayed? Will the terms be challenged? This uncertainty is the reality, and it is a stark contrast to the market's lazy assumption that the check has cleared. This brings us to the recent stock movement, which is the only thing that matters in the short term. Today's 3% pop is meaningless. It's algorithmic trading, it's short covering, it's noise. The real event, the date that every single investor, from the self-investing novice to the professional using the Interactive Brokers trading platform, has circled in red, is November 11th, 2025. That is when Plug is expected to report its third quarter earnings. This report is not just another quarterly update. It is a survival check. The market is holding its breath for one number above all others, the cash position. How much of that $140 million from the end of Q2 is left? Did they burn $70 million, $100 million, or more? Did they secure other financing, perhaps more dilutive and expensive private debt to stay afloat? This will be the first question. The second and equally important number will be gross margins. For years, Plug Power has had the disastrous distinction of posting negative gross margins. They were literally losing money on every dollar of product they sold. The Project Quantum Leap initiative was designed to fix this. We saw some progress. Gross margin loss improved from a horrifying negative 132% in Q1 2024 to negative 55% in Q1 2025, and then to negative 31% in Q2 2025. This is the definition of less bad. It is not good. For Plug to be a viable investment, this number doesn't just need to get less negative, it needs to become positive. The expectation is that this trend of improvement continues. The reality is that in a high inflation, high interest rate environment, input costs are high, and customers are less willing to pay a premium for green tech. If that Q3 margin number stalls at negative 30%, or worse, goes backwards, it signals that the core business model is fundamentally broken. This isn't NVIDIA stock, which commands 70% gross margins on its products. This is a company that is still trying to prove it can just break even. This is why this stock is so dangerous for the average person looking for investment help. You might see Fidelity ETFs or Fidelity mutual funds that are built on diversified, stable companies. Then you look at PLUG, which is the exact opposite. It's a binary bet. This is a stock that attracts speculators. The retail crowd on Robinhood and using SoFi stocks are largely long, holding on to the dream. But you can be sure that professional traders using Interactive Brokers with its more advanced Interactive Brokers platform are looking at the short interest, which remains high. They are betting on the cash burn. They are looking at the macro picture where high interest rates are crippling for a cash-negative company to borrow. A Fidelity Wealth Management advisor or a Schwab Intelligent Portfolios robo-advisor would likely flag this stock as far too speculative for a normal portfolio. It's a pure gamble on the November 11th report. So what does Plug Power actually do? After all this, it's important to know. The company's grand plan was to build an end-to-end green hydrogen ecosystem. This means they make the fuel cells, their GenDrive units, that power things like forklifts for Amazon and Walmart. They also make the electrolyzers, GenEco, that use electricity to split water and create green hydrogen. And most capital-intensively, they are trying to build the hydrogen production plants and distribution network themselves. This vertical integration is the source of the cash burn. They tried to be the oil driller, the refiner, and the gas station all at once before the market for the cars was even fully established. It's an incredibly ambitious model that requires a nearly infinite amount of capital, which is easy to get when rates are zero and the market loves green stories, and nearly impossible to get when rates are high and the company is teetering on a $140 million cash balance. This is the central conflict. The story was never wrong. The world needs clean energy solutions, but the business has been a financial black hole. This is the critical distinction that many investors, especially those new to online investment through simple investing sites, fail to make. A great idea is not the same as a great investment. Apple stock is a great investment because it has a fortress balance sheet and unparalleled profit margins. NVIDIA stock is a great investment because it has a technical monopoly on the single most important hardware for the future of computing. Tesla stock, for all its volatility, executes and generates massive cash flow. Plug Power, by contrast, generates massive cash burn. This brings me to the engagement prompt, and it's a serious one. This is not for speculation, it's about focus. Comment below with the one number you are watching for on the November 11th earnings report. Is it the final cash balance, or is it the gross margin percentage? Both will tell a story, but they might not be the same one. As we look to the future, the outlook is completely binary. There are only two paths from here. The bull case, the expectation, is that the Q3 report on November 11th is less bad than feared. Perhaps the cash burn slowed dramatically to only $50 million. Perhaps gross margins miraculously hit -10%. And most importantly, management must come out and state unequivocally that the $1.66 billion LPO loan is secure, funded, and not subject to the new administration's executive orders that axed the OSED hubs. If that happens,